Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are, Friday, and we're looking back on the week, and also we're going to try and look forward in the markets as well.
Bob, we have 3 listener questions. Our first question comes from Rachel. She writes, "Hi, Bob. Thank you for the great content. Could I ask, do you have a book that you're expecting to publish about financial markets? I think it would be really interesting and a good read. Thanks, your friend Rachel."
Rachel, thank you very kindly. Yeah, the book is a work in progress, and I'm going to tell you, I enjoy writing it, and I'm putting together files that I've had for ages, and putting it in a form that's, I think, going to be readable, but it's going to be many, many months before it gets published. But thank you for the comment on it.
Bob, do you have a title for it yet?
It's long title.
Oh, no, the rambling musings of a market historian looking at the historic files he's gathered and pasted out.
It's ordinary society, its accomplishments, its threats, its opportunities, and it points out that ordinary folk over most of history usually make the right decision either politically or economically, and as a result, society has advanced, and the nemesis to this has always been control freaks. And when they get control, they can really mess things up. But what happens is that the control freaks, well, I've called them tyrannical centuries. The 3rd century in Rome, and then the next one began in the 1500s, and the Reformation is best followed in England, early 1600s, and then the latest atrocity of authoritarians began at about in the early 1900s. And you can look now, even in the supposedly one of the freest countries in the world, the United States, and the politics are absolutely mad. And also, the financial markets are mad. So, here's one of the other points is that when the state gets really ambitious, of course, it depreciates the currency. And when you have a depreciating currency, even in Roman times, the financial markets go crazy. So then that's why you get crazy financial markets with the crazy politics. And then when the financial side fails, then the contraction is such that there's no money for anything, and also the bubble in politics deflates as well. So I think it can happen. I mean, there never has been in the United States such absolutely radical politics and such crazy financial markets. So we'll watch and see how it all goes. But thanks for your question.
We have a question from Michael. He writes us or emails us. Same thing nowadays, isn't it? From Michael, "Jim, this week's interview lineup has been fantastic. Bob, gold is not rallying of late like one would have expected as we approach year end. Is there a major market correction in December or one in the first quarter of 2022? Will we have to wait a few more months for a good entry point in the precious metals sector? In the event of a stock market crash in the first quarter of 2022, some technical analysts see the precious metal sector approaching the 2020 lows before a truly historic bull market in the precious metal sector. Bob, considering seasonality, should we be buying in late December the precious metal sector, or maybe a few more months of patience is in order, considering the topping action in the stock market? So basically, Bob, should we get into gold now or wait?
Yeah, good question, and as we know, timing is everything. It was last summer when we thought that after September things could turn south and there could be somewhat of a credit crisis, and that then would give us would knock the gold shares down, and then we, just as a ballpark date, I just said maybe sometime around November. So what we have going on is that the financial crisis is out there. It's disturbing the markets in Argentina, in Turkey, and to a lot, and with huge implications in China. And what we've found is over centuries, when there are financial problems in outlying countries, eventually hits the financial center, which is now New York. So we've got the credit crisis out there, but the markets have been quite buoyant, largely, I guess, because in October people started ramming up commodities such as aluminum and lithium and cobalt, things like that. So, and also the natural gas and crude oil had very good rallies. So that's got us past when one could see a problem hitting New York, but nonetheless have stayed with the view that somewhere late in the year, now maybe January, there could be a buying opportunity for the gold stocks. And I'm quite convinced we will have the technical talent to recognize the buying opportunity as it arrives. So that's what we'll be doing there. Now, also mentioned seasonality, and I can remember from decades ago in playing the Vancouver junior exploration stocks, and one of the themes was that you kind of, maybe in December, you'd make the list of 4 or 5 juniors that you thought would have a good chance next year, and then you began to buy a little, and you bought a little more between Christmas and New Year's, because that was the time when the promoters weren't promoting, it would be dull. And then also it was a time when you get tax loss selling in the sector, which could also be an issue this year. Jim, and I still remember another story about ages ago, a really bad market for mining stocks in Vancouver. And it was so bad that one broker who was liquid in good shape because he'd sold high thought it's time to get back into the stocks. So those were the days when the big new advance was to have an answering machine. So this broker then figured, okay, here's a list of 20. We'll see if they're alive. He phoned each of the phone numbers, and if there was an answering machine answered, he'd immediately hang up and put a tick on his list there saying that the company was alive and set out to buy them. So it was that bad a market. And then, of course, things change, and it changes for the good. So, yes, the developing turmoil in the financial markets, the boom will fail at some point. And then as the boom fails, the real price of gold will go up. And that relates to profitability in gold mining, and it also relates to the valuation of exploration properties. So it takes a financial storm to set up the right conditions for the post-bubble contraction, whereby the golds would then become, would be on a multi-year bull market, driven by, essentially by gold's real price going up. And this was the case in the 1930s and also previous post-bubble contractions. The gold sector typically does very well. So this is where the next buy point in the gold stocks is very important, because the next leg up could be a few years, and you can get, and it would have, all the majors, the Midland-sized producers, and exploration stocks would all become hot players. And if you're in a deal where you come up with a significant discovery, well, these things can really move. So, yeah, this is ahead of us, and I'm looking forward to it, because I really like the exploration gold junior sector, and when it comes in, it'll be great.
Our third question comes from Kathleen, and, Kathleen likes to include some kind of a musical reference, and sure enough, she doesn't disappoint with this question. She emails us, "Hi, Jim and Bob. Santa's year-end rally has not yet arrived on Wall Street, and the Fed seems to be singing Let It Snow with its tapering talk. The markets out there are frightful, but my short positions have been delightful. And since the Fed has no place to go, let it snow, let it snow, let it snow." On the markets, Bob, has extreme moral hazard finally gotten the attention of Fed Chair Powell this holiday season? Has the Fed no place to go, as many are now suggesting?
Kathleen, thanks again. Your reference to music is always appreciated. I got to tell you, if you can browse the old songs, there was in the 1940s the great Glenn Miller swing band, and there's a broadcast tape where I think it's very close to Christmas, and they do Jingle Bells. It's amazing. It's an extended piece, maybe 5 minutes long or something like that, but it's fun, so you can see if you can Google it, find it, because I like to enjoy it each Christmas. And now, as far as typical, we kind of covered this thing where we can still get a Santa Claus rally, who knows, but the conditions are precarious out there. The adversity will be perhaps further weakness in crude oil. And the other one is that the credit spreads, which is the difference between high-grade and low-grade bonds, has taken they narrowed with the boom right into around June, July, and then reversed to widening, which is a heads up. And then it got stuck for a long time, but recently it's broken out, so it's widened to new levels, but the credit spreads are not yet dramatic. There's the potential there. So you have a very radical financial markets, and I think they're becoming vulnerable, and we'll just watch and see what happens in the first quarter.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, you've dug up some interesting headlines for us to discuss today. The first one is used car prices may never return to 2019 levels. And friend of the show, Wolf Richter, when we talked to him last week, said over 2 years, used vehicle prices in the U.S. have gone up 60%. People are paying more for a 5-year-old pickup than they are for a brand new one, which you can't get right now. They're all on back order because of the chip shortage.
Yeah, I've seen Wolf's chart. He's very good at showing these charts, and it's extraordinary, without precedent, and because the intrusion by all governments to shut everything down on the lockdowns, and then everything's messed up, and then they injected huge amounts of money into the system, and the money always going to go somewhere, so they're buying used vehicles at a rate, and pushing the prices up like you'd never seen. But somewhere, and I've been enjoying cars for a very long time, and somewhere the depreciation will come in, and but again, it would be hinge upon a post-bubble contraction. But I think that a lot of these log jams will ease, like the California blockage of container ships is largely politically driven, and that can break. And then there was the hit to the stock markets and to particularly the crude oil with this new variation of COVID. But that didn't last long. But what it did show is that the market's very thin for most things. There was not many bids on the way down, and then the rebound has been straight up, which shows there's not that many offerings on the way up. So it's a thin market. So, but to the car thing, for an old car not like myself, absolutely fascinating. But somewhere gravity will come in, and I can't pinpoint it ahead time.
Another headline that caught your attention, Turkish lira falling like a rock.
Yep, that's the problem. This first appeared, well, it's important that it occur within a crazy boom year in the financial markets. And then the reversals first appear in lesser or outlying exchanges. And it was in March that even South Africa was mentioned as having a problem with their central bank. But the more important ones were Argentina and Turkey. And with that, the U.S. dollar, the DX, rallied up to 93. That's the right story. When you've got contraction going on, the senior currency typically strengthens. So, but then now you've got serious problems, and it shows up domestically with the local currency, in this case in Turkey, it's the lira, crashing. And against that raises short rates domestically, which can be a problem. So then also, while we've been talking about the property developers in China, Evergrande, and this latest one, Sunshine 100 or whatever, this is an ongoing huge credit contraction. And throughout all of history, even back to 2,000 years ago when the great Roman writer Cicero noted that if there was a credit crisis in the eastern provinces, like at the eastern end of the Mediterranean, Phoenicia then and whatever they call them, if there was a credit crisis there, it would eventually hit the financial center in Rome. And this is indeed what happens. When things went wrong in 1929 in London, which was then the senior market with the senior stock exchange, the blame was placed upon too much speculation in New York, which was then a junior market, and it got hit. So there is a global financial crisis in play. It has yet to hit the senior exchanges such as New York and London. So, and history shows that it's inevitable. We can't exactly say when, but it will happen. And not that I'm looking forward to it, but I hope we get the trade right. And again, it comes back to my preferences for gold. If you have a financial crisis out there hitting New York, then that then sets up the pattern for a lengthy bull market for the gold.
And further on that theme, China developer Sunshine 100 has defaulted on $170 million in bonds. Yep.
That's just another little news story. And isn't it you that says that there's something like 180 million apartment or condo residential units empty in China?
Danielle Parks at 190 million vacant properties in China. Yes.
Ooh, my gosh. That's staggering. So,
well, you have a population over 1 billion, and that would be what, 20% of the population not living in houses or condos that are available.
Yeah.
I don't think there's very many single family detached homes in China to buy.
Well, I think I saw one a few weeks ago where they were starting to tear down the ones that had been empty for a decade because without maintenance they start to deteriorate.
Yeah, so, if you don't seal the concrete, the moisture gets into the rebar and it starts to fall apart, and then you end up with a condo like the one that collapsed in Miami.
Yeah.
Yeah. Now, my question here, Bob, just saw on Bloomberg, the Bank of Canada has a 2% inflation goal for the new year. What can they do about worldwide inflation?
Absolutely nothing. Now, I didn't read the article. Are they hoping to get inflation up to 2% or down to 2%? I don't know. But central bankers have spent the last decade worried that there was too little inflation. And I found some quotes a while ago in the U.S. One of them was that with inflation at annualized rate of 1.8%, it was too low. And so then they open up the floodgates of money. And then when first of all, a bubble was on schedule. And of course, there's where the credit will really flow into is the hot items. And then you had the massive intrusion on the lockdowns, which then really made parts of it extremely dramatic. And this is then what is feeding the huge rise in consumer price inflation. But I think it's temporary because, as I've been outlining, in the final stage of a great financial bubble, the business expansion itself pushes up commodity prices. And these commodity prices, the indexes like the CRB, became, a couple of months ago, as overbought as they were back in 2008, when then that was an important high for commodities. So, and then you've got unusual commodities like lithium and cobalt, and some I can't even pronounce. I didn't even know they were on the periodic table, they're still going up, but most of the commodities made highs during the year at different times and are heading down. So this is what we want to track, is just how long the bid for the inflation story can last. And I think it's a temporary boom in commodities, and only very few commodities are going up. But live cattle and feeder cattle are still making new highs, but others are not. So they're going to be very interesting over the next couple of months.
Also, just saw the headline, U.S. inflation. This is the official inflation rate, which you know is not the real one. 6.2%. That's the highest it's been since 1982. And I recall in 1981 in Canada, buying Canada savings bonds that paid 21%. So obviously they felt the solution to inflation was high interest rates. Do you think they're going to bring in high interest rates to wrestle this inflation down to the ground? Or are they going to raise the rates once or twice and then, as I say, chicken out?
Yeah, no. I think what happens is that too many people believe that when you're in a business boom and prices are going up, that it's the central bank that raises the interest rates. No, I've always argued that what happens is on any business boom, interest rates go up. And then the Fed, and we'll talk about the Fed, follows by raising rates. And then what happens once the boom is over, then you get some distinctions, like short rates like T-bills can go down, but they didn't even really go up. But where the action will be is in lower grade bonds, either corporate or municipals or whatever. And with the contraction, the street discovers that much of the debt can't be serviced and market down in price and up in yield. And this, of course, is what's going on in China. I remember a month or so ago we talked, Jim, and I had seen that the junk yield in China corporations was up to, no, I had thought it was for Evergrande. It was up to 25%. And then when I looked at the chart more closely, no, that was an index of junk bond yields. And that's, last I looked last week, it was up to 28%. So this is what you get in a post-bubble contraction. Lower grade bonds get trashed. So they head up in yield. And then the other one, which now, and we're liking the long bond, the bond future is acting quite well, considering there's a supposed storm of inflation out there. And I think when the speculative markets break, the bond futures will have a nice rally. So this is where, I know the other point I want to put in is that the last time the Fed was concerned about not enough inflation was in the 1920s. You'd had a huge boom in commodities, global commodities, and interest rates went up with that, and the rate of inflation went up. And in the U.S., the annualized rate of inflation reached a high of 24%. And in 1980, in the U.S., it reached almost 15%. And then here's how hard that crash was. In 1921, the rate of U.S. CPI inflation got to minus 16%. So the Federal Reserve was absolutely riveted by the prospects of deflation. So anyway, so then through the 1920s, it was very easy with the money supply, not understanding that the extra lolly would go into speculation in stocks and bonds. And they didn't understand that when the speculation in stocks and bonds collapsed, you get a severe contraction. So here the irony is that today's Federal Reserve, as I said a little while ago, spent most of the last decade worrying that inflation wasn't high enough and were too easy with credit conditions. And of course, what has happened is that the extra money went into financial asset speculation, stocks and bonds, which then along came the business strengthening with the final leg of the financial markets, and you had commodities going up. So I see the Fed as doing the same thing over the last decade as the Fed did in the 1920s, and I think the results will be the same, a post-bubble contraction.
In other words, the Fed doesn't have your back.
No, it's the financial market forces are beyond their abilities. You know, when the Federal Reserve System was formed, movers and shakers knew that if you had a boom and it failed and contracted, then you had a recession. So the theme for the Fed was that it would be, as a lender of last resort, it would prevent the financial crisis that preceded recessions. So recessions would never happen. But since the Fed opened its doors for business in January 1914, there has been 18 cyclical recessions. And in my mind, you'd only need one to disprove the theory, and now it's disproven 18 times. So it just doesn't work. So where they go wrong is that they think that easing credit pushes up the economy. But it doesn't. What happens is that an expanding economy is always accompanied by expanding credit markets, and that's just the way it works. And then when it's over, comes in the contraction. So the irony, Jim, is that let's imagine a central bank that is not aggressive. So and we've seen in the past there have been times when the Bank of England was on a gold standard and limited in what it could do, but you would have fabulous bubbles anyways, like the 1825 bubble. So it shows that the private credit markets can create any amount of credit through leverage against rising prices, and you don't need a central bank for a bubble. But when you have a crazy central bank participating in it, it makes the bubbles wilder. And then the other one is that once the contraction comes in, then the power shifts over to Mr. Margin, and he's putting out margin calls and that sort of stuff. So then you end up with this oddity in economics, which they call velocity of money. And so what happens in the contractions is that the Fed may be pushing out lots of credit, but once the contraction's underway, it overwhelms that as monetary turnover, or they call it velocity, declines. So the irony is that in a boom, you don't need the Fed to create credit because the street can do it on its own. And then in the contraction, the decline in monetary velocity offsets what the Fed tries to do. So this, I think we're going to get another exercise in that. And maybe next week, Jim, we can talk about whether the Bank of Canada is trying to get the rate of inflation up to 2% like it has been for the last decade, or trying to get it back down to 2%. It's a crazy situation.
Now, Bob, I know you've been around a long time, and I don't have any other place to mention this, but they've dug up the world's largest flying critter ever, a dinosaur that was the size of a giraffe and had a wingspan of 40 feet. That's bigger than the wingspan of a Cessna 172, which is 36 feet.
Yeah.
And you wonder, how could something that big fly? Why were dinosaurs so big? Well, the current oxygen content of our atmosphere is 21%. In prehistoric times, it was as high as 35%.
Well, that explains it all, Jim.
It sure does. And somebody asked me, what would something the size of a Cessna eat? And I said, anything it wants.
Yeah. Yeah, I didn't know they were that big, 40-foot wingspans, but I do believe that they lived on cliffs, and it was much easier to take off by jumping off the cliff and then landing there. You've got lots of energy as you start your dive. So, but something that big to try and lift off from flat ground, that would really be quite something, I think. So I'm glad I'm not there.
Well, now you can see why the Flintstones could fly around on them. Bob, thank you so much for chatting with us.
We've been all over the place today, Jim, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He enjoys answering your questions, so you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.